Welcome to Living Smarter with Katrina Carter. I'm Sal, sitting down with Katrina today to talk about something that comes up all the time here in the Bay Area: buying a home when your credit is not perfect. Katrina, thanks for being here.
Hey Sal, thanks for having me. This is one of my favorite topics because I talk to people every week in the East Bay who think the door is closed, and most of the time it's not even locked.
That's exactly what I want to start with. Why do you think so many people with bumpy credit just assume they can't buy a home right now?
I think it comes down to old stories. People hear that you need a score in the high 700s or a 20% down payment, and if they had a rough patch, maybe a missed payment, medical debt, a job loss during the pandemic, they just count themselves out. In the Bay Area, where prices are already intimidating, a credit hiccup feels like one more giant hurdle. But honestly, the lending landscape has shifted. FICO scores matter, but they are not the only factor. You certainly don't need to be in the 800s to qualify. Most buyers I work with are surprised to learn that programs exist well below what their bank told them.
That is encouraging. Let's get into the actual numbers. What credit scores are lenders looking at, and what range do they need to see?
Lenders look at your FICO score, specifically the versions tailored to mortgage lending. FICO 2, 4, and 5 from Experian, TransUnion, and Equifax. They pull what's called a tri-merge report and use the middle score of the three. Now, for conventional loans, the baseline is usually a 620 minimum. FHA loans are more flexible. You can go as low as 580 with just 3.5% down, and even down to 500 if you can put 10% down. Once you hit 680, your rate options improve. At 740 and above, you're getting the best pricing. But here's what I tell people: a 620 or 640 is absolutely a workable number. Don't let the internet fool you into thinking everyone out here is buying with an 800.
Okay, so FHA loans. I hear that term thrown around a lot. What exactly are they? Who are they for? And what do the score and down payment requirements actually look like?
FHA stands for Federal Housing Administration. These loans are backed by the government, which means lenders can take on a bit more risk. That's why they're perfect for first time buyers or anyone who's had credit challenges. The big draw is that 3.5% down payment if your middle score is 580 or higher. Now, if you're between 500 and 579, you can still get in, but you'll need 10% down. There's mortgage insurance involved that stays for the life of the loan in most cases. But FHA is also more forgiving on debt to income ratios. I've seen approvals push up toward 50% DTI, which conventional loans just won't touch. For someone in the Bay Area who's been renting forever and barely saving because rents are so high, that lower down payment and more flexible credit standard can be the difference between staying put and getting keys.
That's a huge difference. What about conventional loans? When does it make sense to push your score up before applying versus just moving forward now?
Conventional loans aren't government backed, so lenders are stricter. That 620 floor is real, and the pricing gets noticeably better as you climb. Here's how I think about it with clients. If you're sitting at 605 or 610 and you're not in a rush, spending 60 to 90 days to get over that 620 or even 640 hump can save you real money on your rate. But if you found the right house in this market and you're worried about losing it, FHA might be your better play right now. You can always refinance into conventional later when your score and equity improve. It's not permanent. The mistake I see is people waiting years to be perfect while prices keep running away from them in Oakland, San Leandro, Castro Valley, San Ramon. Sometimes good enough today beats perfect, never.
I like that. Good enough today beats perfect never. But let's talk about what else lenders are actually looking at, because it can't just be the credit score.
No, it's never just the score. Lenders want to see steady income, typically 2 years of consistent work history in the same field. They look at your debt to income ratio, that's your monthly obligations divided by your gross income. For conventional, ideally you want to be under 43%. FHA can stretch that higher. They also look at your savings and assets. Do you have reserves after closing? Can you handle the payment if something shifts? And here's something people miss: context matters. A 620 score because you had a medical emergency 3 years ago is viewed differently than a 620 with fresh late payments and max cards right now. Lenders look at the whole picture. Your credit score is one chapter, not the whole book.
That makes a lot of sense. For someone listening who thinks, okay, I'm a few months out from wanting to apply, what are your best practical tips for improving that score quickly?
First thing, pull your actual credit report, not just the app on your phone that gives you a Vantage score. You need to see what's really there. Dispute any inaccurate items, but here's a critical warning. Active disputes during your mortgage application can actually put things on hold with some lenders. So do this early or work with someone who knows how to handle it properly. Second, pay down your revolving balances. Credit utilization is huge. If you've got a card near its limit that drags you down fast, get those balances under 30%, ideally under 10% of the limit. Third, do not open any new accounts within 90 days of applying. That hard inquiry and new debt can ding you right when you need stability. And don't close old accounts either. That length of history helps. If you need a rapid rescore, a broker can facilitate that with the credit bureaus directly. It's not instant magic, but it can move the needle in a couple weeks instead of a full billing cycle.
Rapid rescore. That's interesting. I want to shift gears for a minute. Why is working with a mortgage broker different from just walking into your bank?
Your bank has one set of products, their own. If you don't fit their box, you're done. A broker works across multiple lenders and programs. I can match your specific situation, your score, your income, your debt, your timeline with the lender who actually wants that loan. Think of it like this: the bank is a single restaurant with one menu, a broker is a food court. If you're gluten free or vegan or just picky, you need options. And beyond that, a broker advocates for you. When something's borderline, I can present your file, explain the context, push for an exception. Your bank teller is not doing that for you. In the Bay Area, especially where every dollar counts and competition is real, having someone shop for you matters.
I love that analogy. Can you share a real story? I know you've got one about a client whose bank turned her away.
Yeah, this one sticks with me. I had a woman come in, 604 middle FICO score. She'd been to her bank, the one she'd banked with for 12 years, and they basically said, call us when you're over 700. She was devastated, thought she'd be renting in San Leandro forever. I sat down with her and did a full picture review. Her income was solid. She'd been at her job for 4 years. Her debt wasn't wild, but she had two small collection accounts and one credit card at 92% utilization. I connected her with a lender who works down to 580 on FHA. We targeted those two payoffs, got her utilization down to 12%. 6 weeks later, her middle score was 623. We submitted her pre approval, found a place in the Hayward area, and closed in 90 days total from that first meeting. She's still in that house. 3 years later, she's refinanced into a better rate as her credit continued to climb. Her bank never called back.
Oh, wow. 90 days from bank rejection to homeowner. That's incredible. How does this all play out in the Bay Area specifically? Because I imagine people hear these numbers and still think, yeah, but this is the Bay Area.
The Bay Area is brutal in some ways. South prices are high, rents are high. Saving anything feels impossible when half your paycheck goes to a studio. But here's the thing: imperfect credit doesn't change the market math any more than perfect credit does. Everyone out here is stretching. The difference is whether you know your options or you self select out. There are local down payment assistance programs. There are FHA limits that actually cover a lot of the East Bay inventory for first time buyers. The market isn't fair. I won't pretend it is, but sitting on the sidelines because you think your 620 score disqualifies you, that's the biggest mistake. The people who buy are the ones who get the full picture and make a plan, not the ones waiting for some magic perfect moment.
That is so well said. Katrina, we've covered a lot. If someone has been sitting on the sidelines because they think their credit is not good enough, what's your one piece of advice?
Pick up the phone or send the email. Just stop guessing. Your credit score is a number on a page. It is not the final word on whether you can own a home. I've seen 580s close. I've seen 604s become 650s in 2 months. I've seen people who thought they were years away move in before summer. You don't know until someone who actually understands this stuff looks at your full picture, not your bank's app, not a Zestimate, a real review. The worst thing you can do is let fear and old information keep you renting for another 5 years while prices keep climbing.
Katrina Carter, thank you. That is exactly what people need to hear. For anyone who wants that full picture review, you can reach Katrina at 510-288-6002 or Katrina at empirehomeloans.com. Katrina, thanks for joining me on Living Smarter.
Thanks, Sal. And to everyone listening, your door might be more open than you think.